early in the morning today. We hope you had a good night's sleep. And after an action-packed day tomorrow, both full of discussions as well as adventure, and full of content as well as culture, we have a similar day for you today. So we'll now be starting the formal part of the program, and we will have discussions till 5 p.m., post which we will have another cultural excursion, a slightly longer one today. And throughout the day, we'll be making some announcements, some housekeeping announcements about the choreography of those excursions. So please keep an ear out for that. We also have another excursion tomorrow morning for those of you who are still here, and we will be making some announcements about that as well. So to start us off today, we have a very exciting session. This session has been specially curated by our colleagues at the South Africa Institute of International Affairs. And I'll not go any further into the details. I'll let our presenters do that. The title of the session is Building Climate Resilience, Exploring the Nexus Between Global Financial Architecture and Macroeconomic Policy Making. To set the context for this session, can I please call on stage Awa Joof, a postdoctoral fellow at the Institute of Development Studies. Okay, and Mr. Joseph Matola as well, who is an economist at the South African Institute of International Affairs.
Thank you very much. Hi, everyone. So to set the context of this panel, I will use two main points. The first one is about the green recovery and how we missed that opportunity. As you know, COVID-19 had very negative impact at the social, economic, and environmental levels, but it also provided an opportunity for us to put climate change at the center of our macroeconomic policies. And according to the UN Environment Program, the decrease from the green recovery could help us to decrease considerably our greenhouse emissions and then have a chance to meet the 2-degree goal of the Paris Agreement. However, as you can see on this graph, even though during the COVID-19 we decreased a lot our greenhouse emissions, we quickly went back to our old habits by decreasing even more our greenhouse emissions after the COVID-19 pandemic. So this is true for all sectors, but as you can see, manufacturing and energy even contributed more to that increase in greenhouse emissions. So this shows a low integration of climate in policy responses to COVID-19, meaning that we largely missed the opportunity of the green recovery, so far at least. And this is also true in Africa because a recent study from SAIA, led by Joseph here, showed that on average, African countries like Senegal, Tanzania, and Benin did not include very much climate in their COVID-19 recovery plans. And some other countries like Uganda even applied some climate-unfriendly policies, and Joseph could elaborate more about that. My second point is about the fiscal situation of African countries, which can also explain why climate change has not been very much included in our policy responses to COVID-19. Financing can be a big reason for failure to take adequate climate actions, and that was also the case for the COVID-19 pandemic recovery plans. African countries are in a very critical fiscal situation that can be illustrated by their very big vulnerability to a debt crisis currently. And according to the UN, 24 countries out of 54 low-income countries at a high risk of debt distress are located in Africa. And regarding the mobilization of domestic revenue, which can also be a solution to that debt crisis, we see that Africa is still far behind the rest of the world, with a tax-to-GDP ratio estimated at 16%, while the rate is at 19% in Asia, 22% in Latin America, and also 34% in OECD countries. This shows that Africa is also struggling to collect domestic revenue. So this whole picture shows that The critical fiscal situation of those countries can prevent them from applying very efficient macroeconomic policies to fight against climate change, which is more and more frequent and severe, hence becoming an important determinant of macroeconomic policies. I will now give the floor to Joseph, who will do the second part of the context. Thank you.
Thank you very much, Awa, for that informative synopsis of the fiscal situation and the fiscal challenges that many African countries have been facing, and the linkage of those challenges to the issue of climate change. I just want to add some 3 points, and the first point is that, and these are the points that I want all of you to keep in mind. The first point is that where we are right now, we are less prepared, African countries are less prepared to face another shock that may come in the future compared to how prepared they were during before the COVID pandemic. And we all know that they were very much unprepared before the COVID pandemic. That's the first point I want to make. And the second point that I want to make it concerns the initiative that the global community has been engaging in to try to help developing countries, particularly in Africa. And this is to say that these initiatives, such as the DSSI and the Common Framework, while they are very commendable and very helpful, they still fall short on many aspects, and more need to be done. And another point that I want to emphasize, the third point, is that in the case of Africa, due to the structure and the nature of the economies there, climate change is a very important and an increasingly important factor in the macroeconomic performances of these countries, and the macroeconomic policy responses that the countries in Africa are able to implement. In other words, climate shocks are now macroeconomic shocks in Africa. So I'm just going to elaborate a little bit more on these points. So African countries are less prepared today than they were prior to the COVID pandemic. If you look at the data, for example, on debt, African countries on average now have their debt is at 55% of GDP. That's what is being projected for 2023. It was 50% in 2019. So the fiscal space is still very much compromised, and even more compromised now. The fiscal balance is around negative 4% of GDP. And with the ongoing monetary tightening of the world, cost of borrowing is just going to go high, which is still going to affect these countries in terms of their preparedness. The credit ratings were heavily downgraded for many countries, including South Africa, during the pandemic, and so that puts it at a worse position to address the next pandemic. On the point about the international community and the initiatives that are being implemented falling short, we have to acknowledge of the role and the importance that the initiatives that the global community led by forums like the G20, the role that these initiatives did in helping out African countries to address the pandemic. I think the DSSI, we can all acknowledge that it was very helpful for many African countries. And the Common Framework too, I think Zambia can attest to the benefits of that, but we can see the challenges very, very clear. We can start with the DSSI, which very much highlighted one of the major flaws of the international financial architecture as it stands right now, where we saw countries having to make the choices of their short-term fiscal concerns against the long-term debt, creditworthiness or credit ratings, and many countries opting not to engage in the program. So this shows one of the shortfalls or the problems that need to be addressed as far as African countries are concerned. With a common framework, the continued reluctance by some of the creditors, like the private creditors, but I think it is very, very promising that many private creditors have begun to come around. So, but we still need to increase that scope of those initiatives. And lastly, just to elaborate on the point that I was making, that for many African countries, climate shocks are essentially now macroeconomic shocks, and they're becoming the major determinant of their macroeconomic performances and macroeconomic policies. Estimates have shown that globally, between 5% to 15% of annual per capita GDP growth is lost due to climate change. So between 5% and 15%, and for Africa, it's the 15%. That is being lost generally to climate change. There's also an impact on inflation. Some estimates have shown that 1.5% to 3.5% percentage points more inflation. There's 1.5% to 3.5% additional inflation due to climate change because of its impact on food prices, and other macroeconomic indicators. And also on the policymaking side, when it comes to fiscal policy, many countries have to spend resources in addressing natural disasters. These are resources that could have been used for other fiscal interventions, and also they have to cope with the reduced revenues that come from the reduced growth resulting from these natural disasters. So climate change and macroeconomic policy and macroeconomic performances are very much interlinked, particularly for the African countries, and we need to incorporate this fully in our macroeconomic models, in our macroeconomic framework, and in our initiatives in the global international financial arrangements. So I'm going to stop there, and I leave it to you. Thank you. Can I leave this here?
Thank you, Awa and Joseph, for setting us up perfectly for the panel discussion. Could I now request the panelists to please come on stage as I call out your name. Gulbin Sahin Beoglu, who's the Center Director, Economic Data Analysis Center, the Economic Policy Research Foundation, Turkey. Dennis Noer, President, Global Solutions Initiative, Germany. Hai-Hong Gao, Director of the Research Center for International Finance, the Institute of World Economics and Politics at the Chinese Academy of Social Sciences. And to chair this session, Elizabeth Sideropoulos, Chief Executive, South African Institute of International Affairs, South Africa. Over to you, Elizabeth.
Great. Many thanks, and good morning to everybody. I hope you are all rested and ready for a long day, but I think a very stimulating day today. Thanks very much to Joseph and Awa for providing, setting the scene and referring a little bit to the work that they've been doing. I think I actually want to come back to you perhaps at this point and ask you for some elaboration, but for the purposes of the conversation this morning, I think it's to make a couple of initial points, which is that, you know, over the course of the last 2 days, we've heard about the importance of greater African participation in the G20 debates and in the debates more broadly around the global financial architecture. One of these ways is, of course, to bring the AU into the G20, but we've also seen increasing agency from a number of African actors, both at the academic and think tank level, as well as at the governmental and intergovernmental level, to really put forward in a very, I think, forceful and largely coordinated way some of the key concerns that they have around how the global financial system impedes their own abilities to take decisions, whether that's on the macroeconomic front or indeed on the climate front or the nexus between the two. And then last night, Foreign Minister Jaishankar emphasized the fact that, you know, the G20 is about development and growth, and those are fundamental issues for the continent. And a lot of the decisions that the G20 makes or is able, the consensus that the G20 builds in order to push these forward in the relevant fora is very important. So the work that my colleagues have done is work that has been undertaken as a consortium of 6 African think tanks, some of which are here today, which explored over the last 3 years the macroeconomic responses of 6 African countries to the pandemic, looking at the way in which climate was factored in or not, the extent to which these responses created or addressed socioeconomic vulnerabilities, and certainly the dimension around financial resilience. Clearly, what is always apparent in these conversations is the importance of the need for a paradigm shift and a mindset shift, not only in processes where some of these conversations are had, but also at the global level, because macroeconomics are constrained or enabled as much by the global frameworks as they are by the domestic policy choices. And we've already heard about the fact that while climate, this was an opportunity, the pandemic was an opportunity for looking at policies that factored in climate resilience. In many cases, this wasn't the case. What I'd like to perhaps start by asking Joseph and Awa, and then come to the panel, is perhaps, Joseph, some of the specificities around the climate responses of both the low-income and the middle-income countries in your 6-country set, which was South Africa, Nigeria, Senegal, Benin, Uganda, and Tanzania. Perhaps just reflect for a couple of minutes on that in terms of the climate dimension, and then I'll move to the panel.
Thank you, Elizabeth. Yeah, so we have done some work at SAIA and looking at 6 countries: South Africa, Nigeria, Benin, Senegal, Tanzania, and Uganda. So these are diverse countries in terms of their income levels, in terms of the sophistication of their economies, in terms of their industrialization, and in terms of the shocks that they face. But what we did an analysis trying to understand when the COVID shock first hit, trying to understand how much these countries were incorporating climate change into their responses. So for the short-term ones, the immediate responses that happened to our disappointment, if I can say that, but not surprising, was that many countries really climate change was in the back of their mind, and somewhat understandably so, given that when the shock hit, I think the most important thing for many countries was just the welfare, the general welfare of the population. So trying to make sure that unemployment trying to make sure that not too many jobs are lost, not too many businesses completely lost. So what ended up happening is that most countries, when you go into the details of the policies of the interventions, the fiscal interventions that they were implementing, it was mostly what we can say climate neutral. Wasn't green, wasn't climate friendly or unfriendly, with the exception maybe of Nigeria, which had I think we heard the other day they suspended. There was a suspension of the subsidies. They also had a huge program implementing solar electrification for 5 million people, if not 5 million households. So, in a sense, but for most countries, it looks like the climate effects were just a byproduct of what they were trying to do. It wasn't really at the core of their policy making. So, in a sense, an opportunity was missed. But when you look at the longer-term programs that are being implemented, if you try to factor in the other longer-term programs that have come after the shocks, like in the case of South Africa, the just energy transitions and the like, then you find that some countries are actually trying to move in the right direction.
Great. Thanks, Joseph. And let me, and as I call on you, I'll also just do a brief introduction. Let me actually segue into a question to Gulben. I always get the pronunciation of your name wrong. Sainbeyoglu. Right.
Sainbeyoglu.
Director of Economic Data Analysis Center at TEPAV, and ask you sort of a question around macroeconomic resilience in the face of multiple crises. What we've heard from Joseph is we're having to look at the need for trade-offs, which shouldn't be the case. But what should the G20 be driving to enhance resilience and capacity of economies, and specifically looking at it in the context of low-income and middle-income countries? And of course, Turkey itself has played a critical role in the debate around LDCs and LICs through its Istanbul process and so on. But perhaps just a bit.
Thank you, Elizabeth, and good morning. Yes, the world is going through several shocks after COVID-19, the Ukraine crisis, food and energy crisis, and high inflation, and monetary tightening. And I also add earthquakes as well, because Turkey faced devastating twin earthquakes in February that led 9% of GDP damage cost, and it will lead 150 billion financing, requires additional financing that really puts pressure on our budget. So, and also we also know that the national disasters double after 2000, and this is very well outcome with the research. They have this unproportionately impacted low and middle income countries. So we are struggling to invest in development and climate change and addressing the harm and damage caused. So there is a financing gap, as you mentioned. So we have to address immediately to that stress. As you mentioned, 60% of low-income countries are in or on the edge of that stress. So this implies higher grant-based financing and or scaled-up multilateral sources of financing. SDRs can be redesigned and channeled to specific climate change adaptation for these countries. And the third option is, of course, these are available sources of finance. So we have to push for additional financing. This should come from a network of hundreds of government-backed development banks. There are many in different levels, multinational, national, and regional, and they have the experience and know-how of the region and can come up with solutions for the regions and country-specific solutions. And the very last thing, of course, the private capital. Given the distorted government balance sheets because of addressing COVID-19 or earthquake supports like Turkey, there is a wide gap, and that should be filled by private capital. And so the private capital will be the actors of financing real sector transformation, that's clear. And in that sense, G20 can play a critical role in setting the agenda and leading the way for this transition, I think. So thank you.
Okay, I'm going to, you spoke about SDRs, Gulbin, and of course the role of the IMF is very important here in the area of macroeconomics. So I actually want to turn to Hai Hong here. Clearly the IMF has always been, the IMF in Africa particularly is the big boogeyman. It's history of conditionalities that have led to worsening situations in many African countries. Certainly in my own country, in South Africa, when you talk about the possibility of needing to access the IMF, any IMF loan sort of creates nightmares for policymakers. It's a taboo topic. But clearly the IMF is an important player. Over the last few years, it's also increasingly focusing or recognized the intersect between what it does and the importance of mainstreaming climate into it. It's probably not fully equipped yet to do that properly with a full sense of all the consequences of certain of its initial policy approaches. Climate has defined climate as a macro critical factor. But of course, in the context of the pandemic and post-pandemic, the discussions about the SDRs have really dominated the conversation. They're also very much part of a number of initiatives that, whether it's the Bridgetown Agenda, the conversations we had in Paris a couple of months ago, and then there's the Resilience and Sustainability Trust. I mean, in your assessment, I mean, are these tools sufficient? Do they address some of the critical problems specifically related to dealing with climate change so that we're not in a situation where we have to deal with trade-offs? What do we need to see in the IMF?
Thank you, Elizabeth. It is true that the stigma issue, has been with IMF for many, countries in the past. But in fact, the IMF has tried very hard to reduce the problems and also update its, the effort in terms of the adequacy of the funding resources and also the tools. And the lending policy, I think, is more flexible. So it's fair to say the IMF really tried hard to keep pace with time in the past, several years, especially the pandemic. I think the IMF was one of the first reactors to this crisis. Immediately to activate the emergency tools, which were very helpful for many countries, and also enlarge disaster tools, many other short-term support. But we talk about the vulnerable countries and the climate-linked crisis, and of course there are many other crises. The combination, is kind of a very crucial conjecture nowadays. The IMF basically, I think, is quite a little bit in a dilemma, because its mandate basically is still stick with the original one. The Bretton Woods system set up after World War II. The IMF is responsible for balance sheet crisis. It's basically not for sustainable and long-term development issues. That was the original purpose, but obviously it's kind of out of date. And, but because of the mandate, I think IMF really need to be more creative, innovative, to support the countries really, the member countries really in need. I think one thing within the IMF, I think, is SDR you mentioned, and then also you mentioned yesterday. I think the question mentioned again. The SDR, I think, is the most underutilized resources within IMF. It's just Sleeping Beauty over there. It's created in 1996, but somehow, we try hard to utilize it, better use after global financial crisis, 2008. There are a lot of proposals, but none of them just, it's just on the drawing board. And this time, I mean, it's quite critical because, 2021, the IMF, decided to issue new allocations, which is really good. It's really timely, supportive for many countries in short foreign reserves, liquidity problems, as well as, vaccination policies. And now the IMF basically proposed a rechanneling the SDR because, the SDR is linked to the quota contribution. It's kind of a, problem, the bigger, larger, portion of SDR goes to the, bigger contributors. And the most vulnerable, really, they don't have voice, and they have very limited access to these resources. So the new proposal, rechanneling, is really, something we need to, to expect. And basically, this is a step, forward for the IMF to expand a little bit beyond this, comfortable zone before. And another tool, I think I want to mention, you mentioned as well, the resilience and sustainability trust fund. This is really creation of something, nothing before. But there are some, still we don't know, how big, how functioning, how functionable it is. And now the IMF is in a stage of, just attract money from the contributors. And the purpose is for, low-cost funding. This is really, really important because yesterday I listened. There's large demand for concessional loans. And IMF basically, they don't have much tools to do this. World Bank have tools, but World Bank has a problem with balance sheet. So this type of issues, I think IMF really step up. And through those new tools, the IMF could play a little bit more, it's flexible and ambitious. It's not very ambitious, but it's a little bit, it's very brave to step up on this. And I think collaboration between the IMF and the World Bank is very, very important. It's not only, climate issues is not only for the multilateral development banks, it's for international financial institutions, all the layers, including, we talk about financial safety nets, central bank swap lines. Basically, there is something new happening. And regional arrangements, financial arrangements, there are several places. So altogether, I think it's kind of, the global financial safety net is for liquidity purpose. But I think it's time to go beyond. It's for longer need.
I want to ask you something about the SDRs and rechanneling, because this has been a discussion now that we've had for the last couple of years, and the rechanneling has been a bit of a drip, 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 and nothing at the pace that is required. The point that Joseph had made earlier about also the way in which the debt the debt issue has been tackled both at the DSSI and the Common Framework. One of the suggestions that some bodies and groupings have made is that there should be an annual issuance of SDRs. Yes, African countries and small developing countries won't necessarily get as much money, but at least if you have it on an annual basis, it helps rather than waiting on the goodwill of countries to rechannel their SDRs, whether it's into the RST or another. What is your view on that?
Well, because this is just happening, you know, just the IMF is now still in a stage of, you know, attract money, and it's sort of, you know, connect with the new allocation 2021, and the IMF asked for, you know, the countries, you contribute 20% in the initial stage, and then now they just, you know, sped up a little bit. That's 40% of your 2021 allocation, you channel it if you don't use it. I think so many countries in the IMF, you know, they are large holders of the SDR, and they have very strong, you know, external position, very, you know, efficient foreign reserves, which, you know, the SDR completely is meaningless for those countries to hold it. And by doing this and rechanneling, basically, it's kind of, you know, create a channel to, you know, mobilize this part of resources within, you know, among the member countries. And for those, you know, the very vulnerable countries, you know, it's like, normally they don't go to the IMF when they are in trouble. Some go to bilateral swaps, but the Federal Reserve bilateral swaps just cover, you know, the 5 other central banks and major financial centers, but many other majorities of the countries, they are not covered. So, but they look for, you know, some more alternatives. The bilateral swaps, Chinese central bank, and bilateral swaps, I think Bank of Japan has as well. So this is something I think is very important for the IMF to be aware. You know, if they don't do this, there are alternatives. So this kind of this is a very healthy competition, in my view. This is not a substitution. It's a competition, very healthy competition.
Great. Thanks, Ha Hong. I want to come to you, Dennis, and I want to ask you, so as I said earlier, there's a whole range of initiatives on the table. We actually, you know, the bottom line is, and I think we know a lot of the things we need to do, but we're not getting around to it. We know there's a very difficult geopolitical framework in which we operate, but what do you think it will take, given that our time is running out on many of these the levels, and most specifically, of course, on the issue of climate?
I think you've addressed several of the critical points in this debate. Yesterday I was talking with Amar Bhattacharya, who posed the question very simply. We know many of the solutions, but the solutions aren't being implemented, and we should think very carefully about why. And there is a tension between saying that we need a paradigm change, which means a change in our system, and then settling down to little tweaks in the economics under the assumption that the system remains unchanged. And those two things don't go together. And we should think, I think, more carefully about what paradigm change really means. So, you know, I agree with everything that has been said here, and it's terribly important. But if we don't break out of the assumption that the system remains unchanged, then we will continue to expound on the solutions: SDRs, bilateral swaps, debt for nature swaps, mobilizing private finance, etc., and being helpless when this does not happen. So if we go and think seriously about paradigm change, then we need to think simultaneously on 3 different levels. And I will start with the most accustomed level, which is the economic level, where we need to sort out this trade-off between climate and livelihoods. We know for climate, the carbon needs to stay in the ground. And this is still not clear to some politicians. Yesterday, Rishi Sunak in Great Britain announced that we're going to max out on North Sea oil. And that's his contribution to climate action, because he says if he wouldn't take all this stuff out of the North Sea, then it would have to be piped into Great Britain from longer distances, and that would be more energy, and the opportunity cost is his contribution to climate. This sort of madness is something we should address clearly, because the carbon needs to stay in the ground. At the same time, developing countries, as we've heard here and in other sessions, have to deal with the issue of livelihoods. It's not surviving the next millennium, it's surviving the next week. And that requires debt suspension, systematically written into loan contracts for natural disasters, and all this other stuff that we've been considering here. Now, these issues can be resolved. It is certainly possible, but we must face the fact that it's not happening, and us repeating that. So moving to the next level, there is beyond the economic, the political level, governance. When nation states were created, they enabled human beings to deal with challenges at a scale that they were not able to deal with before nation states were created. And that helped us enormously in our evolution, but now nation states are an impediment to dealing with global challenges like climate change. And one needs an understanding that with regard to climate change, sovereignty cannot possibly lie at the national level. It must be at the supranational level, and that will require international cooperation at the level at which the challenge arises. And unless that happens, these economic tweaks are not going to happen. And then moving one step even higher, we come to life. Thing I was talking with Sachin Chaturvedi just this morning. A change in the mindset. And the change in the mindset will help politicians reorient the governance systems. And this mindset is a very simple mindset that can be translated into many different nations and cultures. But let me give you sort of the Western interpretation of life for what it is worth, which is that it's a vision of living in the future with both material and social sufficiency. So currently we focus not only on material needs, but also on satisfying material wants, and we should distinguish very clearly between needs and wants. And we ignore the social sufficiency. Our communities are breaking down, people have less sense of agency, solidarity is disappearing, making it much more difficult to solve these big global problems. So we need to focus on both material and social sufficiency. And then we need healthier, longer, more relaxed lives where we focus on giving everyone on earth a chance to lead a meaningful life. And doing so in a way that makes us both better connected and more collaborative with regard to these global goals, with higher standards of trust and truth, evidence-based. And that's where we need to get to. And the G20 has the ability to use moral suasion on all these three levels: the economic, the political, and the psychosocial. And historically, it is focused mainly on the narrow economic. And as we've heard yesterday evening, the agenda of the G20 is widened, but when we actually talk about what's to be done, then we come back down to little tweaks in the nitty-gritty. And so this is my plea for the G20 to operate on all three levels, because without the systemic change in the minds and the governance and in economics, I don't think the solutions that we have at hand will actually be addressed.
Thanks, Dennis. I think you make your last point is important also in the context of whether we allow the G20 to become paralyzed, or whether we actually, the point of course is that economics is about politics, and you can't ignore that, but you need to still retain in this current difficult geopolitical context spaces which can actually drive some of these agendas forward. And I think what you're saying is that the G20 has to be one of those. We are running out of time. I want to come very quickly to Awa here. I want to pick up on an issue that has already been referred to today and yesterday around just energy transition partnerships. And specifically, of course, we've heard a lot about the South African one. It's a little further down the line. But Senegal has just engaged on, begun that path. And of course, at the same time, in the context of fossil fuel discoveries and so on. Could you just reflect a little on that? And then I just want to come briefly to Joseph. Let me do that all now and ask a little bit about the indicators of the index that you're trying to develop to help policymakers track the intersect between climate friendliness and policy responses.
Okay, thank you very much, Elizabeth. So as you know, and as we showed in our recent study on the macroeconomic resilience of Senegal, Senegal is very much dependent to imports of oil when it comes to electricity provision. And that is a very big issue, because every time that the international price of oil increases, Senegal also go through a very complicated fiscal situation. And we have as an objective to, to include 40% of our mix energetic by 2030 from renewable energies. And this Just Energy Transition Partnership would help us to achieve that goal. But at the same time, we have discovered very important oil and gas deposits in Senegal. And now the question is if we have a contradiction between that, that objective of building resilience with climate responsible policies, and if we should now give up on our potential of gas and oil. But the thing is, I really believe that we can find a balance, because by 2030, if we are able to provide electricity with 40% of renewable energy, while also producing an important share of the remaining 60% with our own oil and gas, I think it will be also a great achievement. I think the transition has to be done step by step, and that we should try to include climate change step by step in our mix energetic, but it can't be done like that, like from a day to another. And also the international architecture, the international finance architecture can also help us, but also have to consider our potential and also our ability to make to take advantage of our potential in oil and gas. And here, what we just have to keep in mind is that our discoveries are offshore, so on the seaside, and it can also have a very negative impact on some people who are relying to the environment to live. So we just have to include that climate factor in our investment, but I think we can't now give up on that, on those discoveries. Thank you very much.
Okay, thank you, Elizabeth, for your question. I think I'll pick from a point. I'll pick up from a point that Awa just made about the contradictions that different countries may be facing when we're implementing these just energy transitions or such programs. I think it's just not just Senegal that has have these other forces working against maybe a just energy transition. If we take it back to South Africa as well, for example, there are political forces behind, and there's also some unforeseen, well, in the case of South Africa, foreseen crises like the energy, the power and electricity crisis, what we call load shedding. I don't know how many are familiar with that term, where you have to have power cuts, and this can actually negatively impact the implementation of these kind of programs, the just energy transitions, because there is an incentive sometimes to go back and to revive maybe coal-fired power stations that are supposed to be decommissioned, but there's an incentive to revive them so that you take care of the immediate power or electricity needs. I think this is not just specific to developing countries, but even in Europe, we saw after the Ukraine crisis, immediately countries revert to utilizing gas more than what they were supposed to. Which brings me to the point on the question that you asked me about the need for tracking for tracking whether countries are really implementing the necessary measures to make sure that they're on track. The IMF does track. It has a dashboard. It tracks the policies that countries are implementing and measure them against their climate friendliness, if I could call it that, and that's what we try to do with SAI as well. But it's not just the issue of climate change that we need to be really making sure that we're tracking. There are many issues, social vulnerability and macroeconomic resilience, and in there we need to make sure that we're tracking all the dimensions that are embedded in those issues. So for example, at SAI we have also tried to track social vulnerability to shocks like COVID, and we have tried to embed in there, to include dimensions like gender, the gender dimension, financial inclusion, and even on the macroeconomic resilience aspect, we also are developing some tools to address those things, and we're trying to track all the necessary dimensions, including governance, human capital, on top of the normal dimensions that we track, the fiscal policies, the monetary policies, and so on and so forth. So it is important that we develop all these tracking tools. I think the IMF can go beyond the current formulation of their tracking and try to have a more like a unified framework, a model, as opposed to be looking at climate almost like in silos, climate change, then we look at fiscal policy separately. Thank you very much.
Great, thanks. I mean, we've run out of time, but what I want to do is just 30 seconds from each of our panelists, from Gulben, Dennis, and Hai Hong, on, you know, we've talked about the challenges and the difficulty. We know what we have to do. We're not doing it. But what are the low-hanging fruit that we might be able to tackle in the short term? Do you want to go first, Hai Hong? Go first.
Okay.
30 seconds each.
30 seconds, okay. I want to mention about our country's homework. We have to do our own bit right. So whatever we do, number one thing to do is to pursue consistent and prudent macro policies. There is no room for macro policy uncertainty to invest on climate change. If there is uncertainty, any investment is delayed, and there's no agenda for climate change. And as Deniz mentioned nicely, policymakers has to have mindset change, and they have to put SDGs in the center of their policy making. So that brings a transparent framework with clear set of targets and transparent progress reporting as well. That will also, even given the narrow fiscal space, it will attract foreign direct investment as well. And also we need to have investment projects. Even if we have the money, we have to absorb the capacity to have these climate change projects. So that's all. Thank you.
Thanks. Dennis, do you want to?
I think the low-hanging fruit is in the measurement. Currently, if we just look at debt, the actual needs of different developing countries are not quantified on a comparable basis, not monitored in a way with a common methodology that prevents developed nations from double counting. So we are not even on first base with regard to debt, and that's really easy to quantify. We've made some progress on quantifying environmental damage, also not consistently across countries. And in the social domain, we are still in the Stone Age, even though we have the data. It is certainly possible to measure solidarity and agency, things that we need to understand the mindsets of people that is absolutely vital for compliance here. And the G20 would be a wonderful place to require such comparable data across countries, consistent across countries, consistent through time, to be measured, then reporting to be based on it. On that reporting, one could then have statistics on the effectiveness of government policy, effectiveness of business performance. That would help us devise new incentives and governance systems. So the low-hanging fruit, the really low-hanging fruit is in the measurement.
To get us to first base. To get us to first base, absolutely. Ahong?
Yeah, I think as far as climate and macroeconomic policy framework concerned, the low-hanging fruit could be, you know, we imagine that could be a new framework, but unfortunately it's not easy to get there. But currently I think it's the easiest way to do is to, you know, to have this risk assessment, which is similar to your suggestions. And this is not something new. Many central banks, the ECBs and many central banks have already adopted measures to make such assessment. And basically there are two approaches. One is top-down. The G20 clearly can do more to collect, you know, consensus and of course set principles, guidelines. And the central banks in the middle, and they are implementing the measures. And then the bottom-up approach is very important. We need the financial firms, banks. They have their self-assessment of the risks. This is really important. This is the way, you know, the data or the assessment could be more accurate. Two approach meeting together. So this is my thought on this, you know, at least climate change taking into account this, you know, macro assessment.
Great. Thanks very much. I know we're 5 minutes over time. The organizers are going to chase us off the stage. Just to say a very big thank you to all of you. I mean, we've covered a whole range of issues in the conversation. I think one of the points that I just want to sort of highlight is that clearly we need a paradigm shift, but I think in the absence of a paradigm shift, what we are seeing is different fragmented initiatives that create in some instances parallel, perhaps complementary structures that have the potential to actually morph into replacements if we don't move quickly enough on these paradigm shifts in the way in which our major formal multilateral institutions are managed. And I suppose what we don't want is an environment in which such fragmentation actually doesn't help to advance, but actually deters an ability to deal with the climate shocks. And there are a lot of issues here that also we in Africa have been discussing, which you touched on. You talk about risk, you talk about credit rating agencies. These are all, I think, significant sort of constraints in terms of the way in which they're regulated and structured for a very, very different world in which we live in. And then the power, of course, of the power of private sector financial institutions, and how those also need to be managed, particularly from the perspective of debt and private creditors and so on. Let me leave it there. We do have some material on the project that we've been talking about, the QR codes at the back. And then I think this is a panel evaluation form. I'm told that you can pick it up on your phones and wherever you're sitting and complete it. Thank you very much. I assume we're now going to tea.
So, could I ask the panelists to come to the front of the stage for a photo? So